I'm Owen Bigland. This is the Inside Edge video blog. Okay, I'm going to touch on a number of topics in this blog here. Let's call it kind of an investing 101 here. I'm going to talk about leverage, portfolio construction with your stock portfolio and retirement funds. I'm going to talk about the difference between cash flow and income on an investment property. I'm going to talk about suitability, growth stocks versus dividend stocks. So I'm going to cover a bunch of topics. Hopefully it doesn't get too unwielding. I've talked about this many times over the last 10 years on my blog. I also go into it in great detail in my book. It's been a while since I've plugged my book. Time for that, because so many people ask me these questions on Twitter or email me or text message me or private message me. And it comes back to that, what I've been talking about for a while, the 100 hours. You can't be spoon-fed a lot of these things. Some of the questions people ask me are very basic. You have to take the bull by the horns here and at least invest 100 hours into learning the basics. So my book, still a bestseller on Amazon after all these years. I've sold, I think, somewhere up close to 5,000 or 6,000 copies of this book, which has blown me away. Read the reviews. It'll be the best $9.95 for Kindle or $14 for the paperback version you can have. I wrote this as a door opener, as a catalyst to get you started on your journey towards financial freedom. I talk a lot about real estate, of course, here, investing for retirement, index investing. I call it along for the ride because it's meant to, because you don't have to be an active investor. You basically buy, hold, monitor, reinvest the cash flows, and just set it off to sea, or what I call in chapter 6 in my book here, the ghost ship to wealth. So have a look on Amazon, along for the ride. Take a look at the reviews before you spend your $9. I think you'll see it's well worth the money. Thanks to everyone who's bought my book, reviewed it, all my loyal followers here on YouTube. It'll be a good door opener for you. But again, this book will take you 3 or 4 hours. You've got to spend another 150 hours, which isn't too much to ask, to learn the basics of what I'm going to brush on in this blog here. It's not difficult, and it can mean the difference between hundreds of thousands of dollars to the average wage earner in retirement funds down the road. I think it's worth putting in the 100 or 200 hours for $300,000 or $400,000 more larger retirement fund. You tell me. But I continue to get a lot of people that will DM, private message me or text me asking me about individual stocks. Oh, and I'm thinking about buying 100 shares of Enbridge or 100 shares of AMD. You know, I can't give you guys recommendations on stocks. I won't do it because I don't know who you are and I have no clue what your situation is. It's what they call on Wall Street suitability. What your age is, what your net worth is, what your other holdings in your portfolio look like. How much real estate do you own? Do you have a pension at work? Where's the money? Where are you putting these stocks? In a TFSA or a cash account? So these are things that I would have to spend hours with someone before I would be able to tell you whether it's suitable for them or whether I would invest in a company like that. You know, for most people, if you've read my book, the majority of you should start, your first couple $100,000 in retirement income should just be put into simple, low-cost index funds. Buy the index, the S&P 500, the VIG, the Triple Q, the XIC. That will do everything you're going to need for 99% of you. Then, after you've built up, I think, at least a $250,000 portfolio or more, maxed out your TFSAs and RSPs, if you have an interest in it, then you can start to look at some individual stocks. But you know, my portfolio is basically broken about 50-50. 50% in index funds, a variety of index funds, mostly through Vanguard and iShares, and then the other 50% is held in mostly dividend growth stock, but I've got a lot of growth stocks in there as well that pay me no dividend. So I had a guy ask me too about, you know, what the difference is. Should I be buying growth stocks versus dividend stocks? Well, again, I don't know enough about you, but what I'll say, I'll just brush on it, just using broad brushes here. It depends on your age. If you are a young person, let's say under age 35, then for sure you should be into some growth stocks or buying some ETFs that have more of a growth names in there, like a Triple Q, which is the NASDAQ 100. Or, you know, the Amazons or the Netflix or Facebook or Google. Don't pay a dividend, but you've got the growth potential there. The Visas, MasterCard, Starbucks is another good one. Low to no dividend, but high growth potential. And because you've got 20 or 30 or 40 years of runway there as an investor. Now, if you get a little older, like into my age, I've still got a lot of the growth names, but I have more what we call kind of a barbell approach, meaning that on one side I have some good, stalwart, sleep-at-night stocks like the Bell Canada and the Canadian banks and the Johnson & Johnson and the Procter & Gamble's that pay me a nice dividend to hold them. You're not going to get huge home runs on the price appreciation, but that's not what they're there for. On the other hand side of the barbell, to balance it out, I've got the growth names, like the Amazons and the Netflix and the Facebook and Apple and Visa and those kind of names. NVIDIA, AMD. They look at your portfolio as a symphony orchestra, a 30-person symphony orchestra. Each stock has a role to play, and together they make good, beautiful music together. If you're too much on one side and all you've got is horns or percussion, it's not going to sound very good. But so much of it depends on your age, growth versus dividend stocks, and also where you hold these stocks. Again, I'll go back to my book here. Guys, spend the $9.95. It took me a long time to write this book. Look at the reviews. I talk a lot about this. I even give you my portfolio and what I'm holding in my TFSA and RRSP and my cash accounts. You know, in my TFSA, I am 100% in growth stocks, most of which do not pay a dividend. This is where I've got large portions of Google, Amazon, Microsoft, which does pay a dividend, Apple, which pays a small dividend. I've got them in my TFSA. It's 100% in US equities, and it's mostly growth names. Visa I've got in there as well. I've owned Starbucks in there, Costco. These are the growth names. The reason being is that it's tax-sheltered growth in the TFSA, and then when you pull it out, it comes out completely tax-free. So this is depending on the size of your portfolio. In the early years, you're not going to be able to do this because you want to balance your portfolio a bit better. But once you hit to a certain level, your growth name should be in your TFSA. This is what we call, your 10 baggers. This is where you want to have those if you're going to have them. So much of it depends on your age, where you're holding these stocks. How many years do you have to retirement? What is your net worth and what other assets do you own? So I can't talk on specifics, and that's why I say start with my book. And in the back, I recommend so many other books, websites on your journey. You have to learn this stuff. You can't be spoon-fed this stuff. And all I ask is that you earn 100 hours, 150 hours to learn just the basics. 150 hours, you will have enough knowledge there to run your own investment portfolio, your retirement funds, buy and hold real estate, or buy investment properties and rent them. My book will give you that good door opener. And then spend another 100 hours or so developing the skills further. You got to learn too about taxation, how different accounts are taxed, the deductions, leverage, which I've brushed on many times as well. Next question. I get this a lot too. People will say, Owen, I want to buy an investment property, but I look at the numbers. With 20% down, I'm not going to have cash flow. So it doesn't seem like a good investment to me. How many times have I talked about this? Again, read my book on this. Now, listen, cash flow is great. If you're in your 70s or 80s and are, retired and living off your investments to live on, you want cash flow. You want a nice dividend portfolio that's yielding you 4 or 5% or 6%. That'd be great. But if you're in your younger years, and even at my age, I am still in an accumulation stage, a growth stage. So cash flow is great, but it's not everything. 20% down buying a condo in Vancouver, let's say, buy a $700,000 one bed, it'll rent for $2,300 a month. You are not going to have cash flow. You have to remember the difference between cash flow and income. Big difference. Cash flow is covering everything, including your principal payment and your interest. You will have, with 20% down on a typical downtown condo, you will have income on the property. After you deduct all your interest payments, your strata fees, your insurance, you'll probably have $2,000 or $3,000 in income, which will be added to your working income and your other investment income and taxed at your full marginal tax rate. So it depends again on your suitability and where you are in life. Investing in Vancouver, real estate, You're not going to get cash flow, but that's not top of mind for me or most of my investors, pretty much all my investors. We're still in the accumulation phases. So what we're trying to do here is a number of things. A, diversification. I don't want all my net worth, all my assets in the stock market. Right now, I'm probably 60% real estate, 40% equities. And as I get older, I might back off and sell a few properties and go more into just good, solid dividend paying equities, and maybe eventually get to something like a 70-30, where I'm 70% in the stock market, 30% in real estate. It all depends though on your situation. But what I want now is a couple of things. Diversification. I don't want all my money in the stock market. The other big thing is leverage. I've done so many blogs, just did a blog a few weeks ago on leverage. Please, you've got to understand the basics of leverage. You put 20% down, borrow the other 80%. It is supercharging your returns. You want to do it in a safe way. You don't want to over leverage. But when you can borrow, I just locked in last week on one of my investment units, a 1.19% variable rate, 1.19%. I've got another mortgage coming up in 2 months. I'm hoping to get something right around that same rate. That's the advantage you're getting there. Diversification, using the leverage, and the long-term capital gain that comes with real estate. It's tax sheltered as you hold it. When it does come time to sell an investment property, you're taxed on it at our current capital gains tax rate, which is 50% of the gain at your marginal tax rate. So far superior than cash flow. Cash flow is taxed at your full marginal rate, 100%. So the other thing too, if you're buying in Vancouver, it's the ease of renting, the high quality tenants. So there's a number of advantages. Don't just look at cash flow on a property. I mean, I'm in a 50% tax bracket. My goal when I buy investment properties is I kind of wanted to break even. Or maybe produce with 20% down, which you have to do. I'm probably going to have a little bit of income on the property. But I'm in a very high tax bracket. I would rather just let it ride, let the tenant do the heavy lifting. When it comes time to sell it, I will sell it at that more favorable capital gains tax rate. In the meantime, I'm taking advantage of the leverage at 1.2% right now. So you have to understand these things, the difference between cash flow and income on a property, and what leverage can do, and what diversification can do, and what suitability is all about. So many things to look at. There's no one size fits all. And that's why I've been stressing this for so long. And I know most of you guys are fantastic that watch my blog here. You've bought my book. You've bought some of the other books I've recommended. You're going on to websites like Seeking Alpha. You're going on to websites, one of my favorite, if you're a Canadian, is Canadian Couch Potato. That Canadian Couch Potato, you could spend 40, 50 hours there on your education. That's a university education on that site alone. It'll teach you how to index invest, how to build a proper passive portfolio using low-cost ETFs. They have a fantastic tax section in there. You got to spend at least 2 or 3 hours on how things are taxed in a cash account, in an RRSP, and in a TFSA, and the advantages of it. I see people's eyes glaze over when you talk about the U.S. dividend withholdings tax. You better understand how this works. If it's in a TFSA and you're earning a U.S. dividend, you're going to get hit with a 20% withholding tax that is not recoverable. In a cash account, that's where you should hold dividend-paying U.S. equity. They'll still hit you with the 20% dividend withholding tax, but it's recoverable. Your accountant will file and you'll get it back. Or it's also not applicable in an RRSP, a US dollar RRSP. I know people's eyes are glazing over. What did Owen just say there? Again, I'm not going to spoon feed this. A lot of it I talk about it in my book, Canadian Couch Potato. Go on to the tax section in there and learn this stuff, folks. I'm giving you guys this as a catalyst again, and why I wrote my book as a door opener. But you have to take advantage of these things that are there and learning the basics of it. Do it yourself. Don't rely on the banks or money advisors and money managers to do it. If you want to, that's fine. But it's costing you huge People have no idea how much money it is going to cost them at the end of the day when they turn 65 or 70 by using a professional money manager. When you could do it yourself passively through ETFs, we're talking hundreds of thousands of dollars. If you ask me, that's worth the 100 or 200 hours to put in to learn this stuff. I'm Owen Bigland. Thank you to all my new subscribers. Thanks again for everyone who has bought my book on Amazon and reviewed it. I've got dozens and dozens of fantastic reviews there. I also see in my comment section here all the time about people saying they bought my book. It was a door opener for them. It really opened their eyes to how investing and saving for retirement, how leverage works and all that good stuff. And that's exactly why I wrote it. Thank you for everyone that's commented on it in the past and given me a review on Amazon. I'll see you guys next week.